Now let's hit your money because let's be blunt. When the tariffs were first announced on April 2nd, markets got crushed. Headlines were all over the place, and not just in the business media. General news leading with stories about stocks falling. I even heard a show talk about retirees, quote, being wiped out. But Fundstrat's Tom Lee did not take the bait. He advised clients to hold fast. Said that markets would have to make new highs or would make new highs this year. And guess what? We are there in one of the fastest stock recoveries in history. We are not quite positive on the year yet. Maybe this is the high. Maybe it won't happen. But this has still been an amazing bounce back. Joining us now is Fundstrat Global Advisors Head of Research, Tom Lee, also a CNBC contributor. I think you're in like a studio, so you can't run like an actual victory lap, and maybe you're not there to do it yet. But Tom, what did you see that apparently so many others miss? Because I thought we were going to zero.
Well, and zero is always a possibility, Brian, but I think it comes down to three things. You know, the first is the high yield market never confirmed the panic that we were seeing from the economists about the economy. High yield spreads did widen to like 439 basis points wide. But if we were barreling into a recession, they'd get to 700 or so, and they're back down to like 360. The second is that the stock market did have a liquidation event, as you point out, but waterfall declines, all of them, 17 out of 18 since 1950, had a V-shaped recovery. So we knew that whenever the bottom was established, the bottom would be a V-shape. 2022 was the only real exception because of Jackson Hole. And the third is we had a lot of faith in businesses. You know, these companies have been battle tested. They survived a pandemic shutdown. They survived a bullwhip effect from a recovery. They survived the fastest rate hikes in history. So I think that businesses really should get credit, and they've delivered earnings even for Q1 and for guidance that have been way better given the Armageddon that we expected. So I think those three things are the reasons we sort of told our clients to kind of buckle down and even add exposure.
You know, I did something I almost never do, Kelly, which is I deleted a tweet because I tweeted out around that time. I was like, "You're not really losing money
thinking about that tweet.
Until you sell." And
you
I meant it.
Left it up.
No, I should have, but I meant it, Tom, as a reference to this show that I was listening to on another network where they said retirees are being wiped out. And I was frustrated. I tweeted out, people got a hold of it, and it took this life itself. But my point was that unless you're retiring in a few months or a year, whatever, or you're 80 years old, whatever it might be, you don't. It's better to be in the market for a long time than to try to time the market. Correct? Like if you're a trader, hedge fund, that's one thing. But if you're a longer-term investor with a timeline of more than 5 years, the bias is clearly to the upside. But I think because the sell-off was so politically oriented that it kind of took on a life of its own. Would you agree with that?
Yeah. I mean, there's a couple of factors at work. We were highlighting it during the tariff dislocation, but we know that the equity professional universe of investors, you know, looking at political surveys, more than 60% are Democratic leaning. So their interpretation of the actions of the White House was half empty. So we saw an exaggerated move in equities relative to the bond market, where in the bond market it actually is flipped. In the fixed income world, 60% of bond managers are registered Republicans. And so that's why I think you get better signal, at least in this instance, from what the bond market was doing. And the second is, of course, something people have talked about is the 10 best days. You know, we were highlighting this multiple times that if you exclude the 10 best days of 2023 or the 10 best days of 2024, the S&P only returned 3% a year each of those years. So you need to stay in the market, as you point out, in order to get the 20% gains. And I think this year is another example of people rage sold at 48.35, and now they're buying in today. They missed 1,000 points or 20 percentage points of a gain in 2025.
Do you have any thoughts on kind of bond yields at these levels? Does it matter? I mean, just kind of picking up on what we were just discussing. And for those who missed and wish that they had piled in at the lows now a month ago, what do you say now? That no one now wants to go, all right, fine, I'm going to make my move now, and now stocks are back at the highs. Maybe we then slide lower again. So just some kind of general advice.
Yeah, I've got a couple pieces of advice. I mean, right now, the 10-year yield at 4%, I think isn't a huge burden for not only for the government, but also for the economy or for companies. So I think it's a level of funding that businesses can earn a return on capital. And then as we think about 2026, there's a lot to be excited about. We have deregulation coming. We have the tariff debacle behind us. We have tax cuts possibly. And then we might have better trade partnerships with other countries, meaning U.S. companies have earnings upside. I think that the market is flat year to date through May. So I don't think anyone should feel like they missed anything. I think that they're going to have a chance to buy a lot of companies. A lot of stocks got obliterated. And I think that these washed out names are still opportunities, whether it's Tesla or the Mag 7 or the small caps. There's many opportunities.